Forbearance numbers are up across the nation, but not only that, they're up here in the Bay Area. What does that mean for Silicon Valley home buyers and sellers? Coming up on the Silicon Valley Snapshot. This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another Silicon Valley Market Snapshot for the third week here in September of 2020. Before we get into the data, before we get into the trends, if you are a home buyer in today's market and you are looking for the most comprehensive data set to help you make a home buying decision in any area, any market here in the Bay Area, go ahead and text the word data plus the zip code, neighborhood, or area that you're looking in, and my team will get you the most comprehensive data set available to you. And if you're a home seller in today's market and you're looking for data to help you guide your decision making in terms of pricing or in terms of timing, now more than ever, that data, the data that we provide to you, is imperative to making the best decision for you and for your family. Go ahead and text the word data plus your property address to the number down below, and we will get you the most robust, comprehensive data set available to you as a home seller in today's market. Now, let's get into the data, everyone. Let's get into the numbers. And before we even go into that, one of the articles that I saw recently on the San Francisco Chronicle, very interesting take on what's going on with the forbearance here locally in the Bay Area. Now, one of the first lines in the entire article, right? The article is titled, "Mortgage delinquencies increased at record rates in April," right? This is back in May, granted, of 2020. So let's look at this. So California and the Bay Area, this is from the article, California and the Bay Area have a far lower share of non-current loans than the national average, which contributed to a particularly high month-over-month change. In San Jose, they jumped to 2.8%, okay? In the San Francisco metro, they jumped to 3.59%. And we all know that forbearance numbers, delinquencies have gone down since May across the nation. So even back at the peak of the forbearance crisis, we'll call it, here in the Bay Area, the effects were not felt nearly as high as the national average. They weren't felt nearly as hard or as high as the national averages. And so what that means for us is that what I've been saying, if you've been watching these videos for any period of time, you'll know that whatever is happening nationally, we are a more exaggerated version of that. Whether the numbers are worse or better, it's exaggerated. So in this case, it's better, right? In terms of the stability of the market. And speaking of stability, the last 3 months have been the epitome of consistent when it comes to the trends and the data that we're seeing here locally in the Silicon Valley marketplace. And if you've been watching these videos for any period of time, the numbers that I'm about to share with you should not come as any surprise. In fact, if nothing else, it should just look pretty much the same when you're looking at videos from weeks and months previous rather. You'll notice that the story remains the same. Inventory levels are very low compared to this time last year, and pendings are very high compared to this time last year in most metros and most counties around the area. So when we look at Santa Clara County numbers, you'll see that month to date, so the acceleration of the market into the first 16 days of September, we're looking at a 23% decrease in for sale inventory, 22.7% to be exact, and a 38.6% increase in pending sales. The net difference there, a 50% spread from where demand was a year ago today. Flip over to San Mateo County, we'll see something that we haven't seen in a while, where pending sales are far outpacing inventory. The market has turned there significantly. A few weeks ago even, we were seeing San Mateo County behave slightly differently than Santa Clara County in the sense that the inventory was outpacing the demand, or the delta in inventory year over year was outpacing the delta in demand. Now we're seeing demand up 62.4% year over year, and we're looking at 5% increase in inventory. So demand is far outpacing supply, the acceleration of that month to date. So let's pay attention to that, because even a month ago, we were saying, wow, if these trends continue, if the trends that we saw a month ago continue, we could see things flip into buyers' favor. Well, this is not in the buyer's favor at all. So we're seeing a stronger market emerge in San Mateo County, which should be music to any home seller's ears who's currently putting or thinking about putting their home on the market in San Mateo County. Flipping over to San Benito County, all the way down south, we're seeing very drastic changes in the numbers. 51% decrease in inventory year over year, month to date. Acceleration-wise, very slow. Only 62 homes on the market right now in comparison to 127 this time last year. And then when you look at the pending sales, 119% increase in pending sales, meaning that the market right now is just so incredibly hot in San Benito County compared to the same time last year. Now, the pending sales are not outpacing the inventory, so we're not seeing a drastically heavy buyer's market. But compared to what home sellers and home buyers were used to experiencing a year ago today, my goodness, it feels a whole hell of a lot hotter for any buyer and any seller in that marketplace. 170 point spread. Incredible. Let's hop over to San Francisco now. If you guys watched a video I made about a month ago where I talked about San Francisco's crisis, we're looking at the inventory levels and the pending levels right now. 79.9% increase in terms of inventory and a 79.4% increase in terms of pending sales. Now, this doesn't tell the whole story, because a year ago, the San Francisco market was very cool. It was a very cool market. And so the numbers seem to indicate that the inventory levels and the pendings are rising at the same rate, which is true. So the net effect is a neutral market. However, this time last year, it was a buyer's market in San Francisco. So it's still a buyer's market. It just hasn't gotten any worse or better for either side at this point. But the fact remains that there are 1,749 homes for sale and only 300 homes pending. That's bad. That's very, very bad. And so month to date, we're not seeing as drastic of a change in skew of buyer's favor as we were seeing in August, but we're definitely still seeing a very strong buyer's market in San Francisco right now. Flip over to Contra Costa and Alameda County, the two strongest counties right now, really in terms of overall sellers markets. Alameda County, a point spread of almost 100 points. We're looking at actually 87-point spread in terms of demand versus supply compared to this same time last year, month to date. So the acceleration right now is heavily skewing in sellers' favor. Same thing with Alameda County. Sorry, that last one was Contra Costa County. This one, Alameda County, 32% decrease in inventory and a 45% increase in demand month to date, year over year. Incredible. I mean, when you look at that, when you talk about the point spreads, I mean, it's absolutely insane to see how much sellers right now, or how much leverage sellers currently have in these markets. And that's kind of the punchline, folks, is that, you read the forbearance news and people start to get worried. But the reality is that there is so little inventory on the market right now that even if those, 3% or so that are in forbearance right now all end up having to sell their homes, that is going to nominally affect the inventory levels here in Santa Clara County, San Mateo County, San Benito County, Alameda County, and Contra Costa County. San Francisco is a whole nother subject, but when you look at those five other counties, you really start to realize that the market right now is priming itself to withstand any sort of fallout that we have from any type of forbearance or foreclosure type issue. And the reality is that even if that does happen, the equity that these people who are in forbearance are building right now will protect them from having to go into foreclosure to begin with. There will be no short sales. There will be no foreclosures. If you're sitting there and you're waiting for the market to crash, good luck. I encourage you to pop a bag of popcorn, sit there, and eat your popcorn for the next forever, because it's not going to happen, folks. It's really not going to happen. The market right now is too strong. The numbers are too heavily skewed in sellers' favor. I represented a buyer 6 months ago in Evergreen, and I just sold to his best friend the home next door, and the market has appreciated in that time frame 6% from April of this year, of 2020, until today, September. That is 5 months. In 5 months, the market has appreciated 6%. Think about that. That should tell you how fast the market is accelerating. Do you think that foreclosures and short sales are going to happen in this kind of environment where prices are rising so high? There's too much buffer being built right now. Wake up, folks. This is Danny Gould with the Selling Silicon Valley Group, and I'll catch all of you in the next video.